Compound interest. We have all heard it called the eighth wonder of the world, the magical force that turns loose change into a fortune, and the ultimate secret to financial freedom. But what most people, especially hard-working savers in the US, fail to realize is that the popular story we are told is actually a myth, and falling for it causes most people to start way too late. It is a silent trap that delays your true wealth. Before we dive into the numbers, I need to be completely transparent with you. I am Arthur Leo Stone, and everything I share here is for educational purposes only. I am not a financial advisor. Every strategy one discusses involves risk, and your personal financial situation is unique. Please consult with a qualified professional before making any investment decisions. The information I provide is intended to help you understand the game, but the responsibility for your financial future rests entirely on your shoulders. If you caught our last video, Assets versus Liabilities, you know that we focused on stopping purchases that drain your cash flow. But today we are talking about what happens when you finally have spare capital, and why waiting for the perfect moment to invest is completely destroying your future. Right now, millions of Americans are making a massive calculation error. They think that compound interest works like a microwave. You pop your money in, press a button, and wait until the very end to watch it explode. They believe they need a massive salary, a lucky break, or a complex portfolio before they can even begin. But here is the cold, hard truth. If you are waiting for the right time, a large salary, or complete certainty, time is slipping through your fingers. Every single day you delay is a day your money loses its greatest advantage. Today we are going to expose the compound interest myth, calculate exactly how much waiting is costing you in lost decades of growth, and give you a precise, step-by-step US-based action plan to harness exponential growth right now. This is critical, so pay close attention. Let's break this down so there is no confusion. Compound interest is simply the process where the interest you earn on your investments begins to earn interest of its own, creating a snowball effect. But the myth is that this snowball requires a huge hill to start rolling. People think, I'll start saving and investing once I earn more money, once the market drops, or once I have everything figured out. That hesitation is fatal. Wealth building is a habit before it is a number. If you cannot start small and stay consistent, larger amounts will simply slip through your fingers when they finally arrive. Think about it this way. Imagine two investors. Investor A starts at age 25, investing just $200 a month consistently. Investor B waits until age 35, just 10 years later, to start, but doubles down and invests $400 a month to catch up. Because of the sheer power of time, Investor A ends up with significantly more wealth at retirement, even though they invested half as much out of pocket. Why? Because time in the market will always beat timing the market. When you delay your start, you aren't just losing a few dollars of savings, you are wiping out decades of exponential multiplication. This is why procrastinating on investing is so dangerous. People think they are being prudent by holding cash until they feel ready, but they are actually benching their best workers. Every single dollar you invest acts like an employee working 24 hours a day, 7 days a week, without ever taking a vacation or asking for a raise. When you wait, you leave those workers sitting on the bench while inflation eats away at your purchasing power. You are working hard for your money, but your money is working against you. To break free from this, you have to stop waiting for perfection. You do not need to time market drops, predict economic shifts, or master complex financial instruments on day one. You just need to start building your portfolio with simple, reliable, and steady instruments that compound quietly in the background. As you look across the arc of your working life, remember that the psychological resistance to starting small is your greatest hurdle. Those early dollars are the heavy anchor stones of your financial fortress. They carry the longest timeline, which means they undergo the highest degree of multiplication. When you rob yourself of those early years, you force your later stage dollars to work 5 or 10 times harder to achieve the exact same net result. Consider the human cost of delay. When you wait until your 40s or 50s to take investing seriously, you are suddenly wrestling with tight margins, family expenses, college tuitions, and diminishing runways. The stress of trying to outsave lost time leads to emotional decision-making, panic selling, and chasing speculative trends that destroy capital. True wealth is boring. It is methodical. It is built by planting seeds in quiet seasons and letting the steady rain of compound interest do its relentless work over decades. Now you might be saying, Arthur, I am ready, but where do I actually put my money to let it compound safely in the US market? And look, that is the right question to ask. To make compound interest work for you, you need an engine that generates steady returns over the long haul without requiring you to micromanage every single daily market swing. Let's look at a practical, three-step US-based framework to put compound interest into motion, keeping in mind that all investing involves risk and you must do your own research. Step 1 is establishing your baseline discipline. Automate your investments. Do not rely on willpower at the end of the month when bills are paid and temptations are high. Set up an automatic transfer the day after you get paid, moving a fixed amount straight into your investment vehicle. Step 2 is choosing the right vehicle. 4 long-term compounding broad market low-cost index funds, like S&P 500 ETFs such as VOO or VTI, have historically provided the steady, reliable engine needed to let compounding work its magic over decades. Now you might be wondering, when it comes to choosing your long-term engine, should you go with VOO or VTI? Let us break down the difference simply. VOO is the Vanguard S&P 500 ETF. It tracks the 500 largest publicly traded U.S. companies like Apple, Microsoft, and Amazon, giving you exposure to the absolute giants of American industry. VTI, on the other hand, is the Vanguard Total Stock Market ETF. It holds over 3,500 stocks, capturing not just those large-cap giants, but also mid-cap, small-cap, and smaller U.S. businesses across the entire domestic economy. The bottom line is this. Historically, their performance is almost identical because the biggest companies dominate both funds. Choose VOO if you want to focus strictly on the largest market leaders, or choose VTI if you want ultimate, all-inclusive diversification across every single corner of the U.S. stock market. By housing these inside tax-advantaged accounts like a Roth IRA or a 401k, you protect your exponential gains from being chopped down by taxes every single year. Step 3 is ruthless patience. Once your money is in the engine, leave it alone. The biggest enemy of compound interest is emotional interference, panicking during a market downturn, selling at a loss, or trying to jump in and out of trends. Compounding requires uninterrupted time. Think about the psychological toll of this as well. You work 40, 50, 60 hours a week and you save a portion of that check with the goal of creating a better life. But every month you see prices rise, you feel the pressure, and you wonder why your savings account balance never truly translates into freedom. You think it is just bad luck, but it is not bad luck. It is a mathematical reality of leaving your capital idle. When you fail to put your money to work through compounding, you are voluntarily accepting a backseat in your own financial life. You are letting time work against you instead of for you. To truly understand this, you must expand your perspective beyond the next month or the next year. Wealth generation is a multi-decade game. When you plant a tree, you do not dig it up every week to see if the roots are growing. You water it, you protect it, and you let nature take its course. Compounding is the exact same process. Your monthly contributions are the water, the index fund is the soil, and time is the sun. If you interrupt that cycle, you reset your progress entirely. This brings us to a critical realization about how the financial system is structured. The traditional path, saving your money in a low-yield bank account and hoping for the best, is a relic of a bygone era. Today, with the velocity of modern markets and the steady creep of inflation, passive cash holding is a guaranteed way to fall behind. You must become an active participant in capital growth. You must shift your identity from a mere saver to an intentional investor who commands their money to multiply. When you make this shift, your entire outlook changes. Market dips no longer cause panic. They become opportunities to acquire units at a discount. Long-time horizons no longer feel daunting. They become your greatest competitive advantage. You stop looking for shortcuts because you realize that the most powerful force in finance, compound interest, is already working quietly in your favor, provided you give it enough runway and absolute consistency. Think about the alternative, remaining trapped in the endless cycle of hesitation, watching your financial runway shrink year after year while you work harder for fewer tangible rewards. You have the power to break that cycle right now by shifting your mindset from passive waiting to active capital deployment. In our next video, we are going to tackle understanding net worth, the only scorecard that actually matters, and I am going to show you how to measure your true financial progress so you can track your compounding growth step by step. You do not want to miss it. If you found this deep dive into the compound interest myth helpful, please show this video some love. Hit that like button right now. It helps this US-based financial education channel grow. And subscribe and click the notification bell so you never miss a new strategy. Share this video with a friend. We're building a community focused on mastering your money, and we need you in it. To get a free tool to help you start taking control, including assessing your savings rates and identifying invisible drains, head over to www.arthurleostone.com/wealth-audit to grab your free wealth audit checklist. Let's stop letting delay rob your future, and let's build true financial freedom together. Drop your thoughts in the comments below, share your biggest takeaway, and I will see you in the next video.